Hello, everybody. Just letting a couple people cycle in here. We'll get started in a minute here.
Okay. Yeah, I think we have a lot of people here. So, but thank you. Want to thank everybody for joining us here today on the webinar for creating a succession planning for financial advisors. And my name is Joe Nupieri. I'm the co-founder of Compass Acquisitions. I'm also joined here with my partner Scott Brittman.
Hello, everyone.
And also today we have a special guest. We're excited to have Dustin Mangone from PPC Loans as well joining us. He's one of our preferred lenders and does a really good job with the financing aspect. So he's going to go into some deal structure items and things like that. Hi, Dustin.
Thanks, gentlemen. Thanks for having me today. And just a quick background for those of you who don't know about PPC. I'm the managing partner and I oversee the investment advisory program for PPC. And we are a lender that focuses on cash flow based service sector businesses, most importantly, independent investment advisors. And we serve as an ongoing capital partner with the ability to provide for all your traditional debt needs, which could be acquisitions, mergers. We do next gen financing for buy-ins, buyouts, equity purchases, as well as some ancillary needs like working capital and lines of credit.
Great.
Perfect. Yeah.
Thanks, Dustin.
And if anybody has any questions during the webinar, feel free to raise your hand. And I can actually open up the chat to anybody that wants to talk or have any questions like that. So just feel free to raise your hand. We'll try to keep this to about an hour, a little underneath. But yeah, I appreciate everybody hopping on here. We'll kind of get right into this here. With Joe can start off with the first slide with an introduction.
Yeah, actually, absolutely. Thanks, Scott. We'll definitely encourage participation. I think it makes it a little more enjoyable, but go right into it here to be mindful of everybody's time. So some of the topics being covered. So we're going to talk a little bit about, evaluating some of your succession options that are out there. Also finding the right successor, which is certainly an important topic that we discuss on these every month. And then Dustin's going to go into structuring the deal. He's going to talk. He's got a few really good insights that he's going to provide us here today. But so we'll kind of give the floor to him on that, and touch on business valuations, which both Scott and Dustin will talk a little bit about today. Really, how to maximizing the value of your business as well. And then just some of the items that might affect valuation, up, down, indifferent. So just kind of cover some of those topics, and then really just timeline options and what you're based on what your timeline is, what that looks like, and what some options are there for you. So that really gives an overall view of what we're going to cover. So I'll kind of get started into this first one here on evaluating succession options. So, that's something I talk about a lot with advisors, whether it's, identifying somebody internal within your own firm. Obviously, that's going to be a really easy way. It's not always an option for many advisors where they don't have somebody internally there who is either wants to take over the book, or maybe they don't want somebody internally to take over their practice. So that's always an option. And whether it's just somebody in your firm, obviously no repapering, no ACAT process, certainly is an easy way to do it. And then also kind of grooming or mentoring somebody, bringing in a junior advisor. I think, I've seen it happen successfully. I've also seen many scenarios where it's unsuccessful. I think the challenge there with grooming somebody new is most advisors, when they're nearing the last 5 or so years of their career, maybe even 5 or 10, a lot of them don't want to bring on and have to manage and train somebody new. And then, also the challenge with that too is they may work for you for 2 or 3 years and ultimately decide that it's not going to work out for them. So then you're kind of stuck looking, back from square one, so to speak, looking for a succession plan. So I've seen, it can be a challenge, but then there's also, sons, daughters in the business. We see that a lot as well, which can work out very successfully. If neither of those are a good option for you, or you would explore external options, like a merger or sell and stay, full partial acquisition. So looking for a different firm, it could that could even mean within your own broker dealer too. So if you're with LPL or whatever broker dealer you clear through or use, you might have a firm that's technically would be considered an external option, but keeping it within the same BD, helps that repapering or ACAP process. Same with RIAs and custodial, Schwab, TD, that sort of thing. So that's always a really good option. And then really just determining kind of all three of them. What's going to work best for you. Financially, as well as what you're looking to do, what you're looking to accomplish, your client base. You want to make sure you find the right fit. So that's something we're gonna really talk about a little bit more in this webinar. But those are just some of the outlier options that you have when you start to consider a succession plan.
Yeah, and keep in mind too with the junior, and I say this all the time, junior advisor always seems like a great plan until you invest your time into it and they end up dropping out. And the dropout rate of younger advisors in this field right now is north of 90%. So just be careful with that. Make sure you have somebody good that you trust that is going to stay in this thing before you move forward with that. But on to this next clip, and Dustin, I think you can kind of take. Or is it still us?
Yeah.
Oh yeah, I'm
Yep.
sorry. Well, a couple more before we get into Dustin. Finding the right successor. What are the must-haves in a potential successor? I think that's very important for yourself to kind of get into this before you start talking with people, or kind of jot down what are your must-haves in a potential successor. If you're with a big broker dealer like an LPL or Raymond James, something like that, you may want to, not have to switch or repaper your clients. And it's a lot easier when you have a big BD like that, where we can go find you somebody within your BD, or you may have somebody yourself. But you want to kind of figure out what are my non-negotiables, your deal breakers, and everything like that before you really start talking with people. I would make that very I'd be very upfront about what my deal breakers are while you're speaking with people, just to save your time, so you don't go through conversations and ultimately end up deciding that this is not a great fit for you. I think it's in your best interest to kind of be upfront with what you're looking for. And right now, there's 50 buyers to every one seller. You probably can find what you're looking for. It may take a little longer than you hope, but ideally, you should be getting into something that you feel comfortable with. Does the personality of the buyer match up well with your clients? Always, something that you want to look out for is the best interest of your clients. I don't have to tell you guys. I mean, most of you guys have been working with your clients for, 10, 20, sometimes 30, 40 years. You want to make sure that they're well taken care of when you do pass them over to your eventual successor, and you want to make sure that they're going to be a good fit for your clients there. Does their investment portfolio match your investments? Obviously, a big thing is portable. How portable are clients? And those are things you want to make sure that you're looking into before you're getting into the big due diligence process of figuring out if this is going to be a fit. Ameriprise is a good example with something like this. They may not take a lot of the products, or you may not be able to take a lot of products from Ameriprise. and put them into similar products within your BD. And there may be some issues when you're trying to do a transition with that. So definitely, look into that. Make sure that they are portable to whoever you are speaking with, if it is an external transition, and weigh the pros and cons of each potential buyer. If you're being introduced to a couple of different people, figure out who's going to be the best one. Write down on a list. I always tell people to keep a pad, and whatever pops into your head, really just start writing it down, jotting it down, and we'll help you. If you need help with that, we're certainly here to help you figure out that process as well too. Structuring the sale, and this is Dustin will come in right after this slide. But you kind of want to figure out what you want up front. Payments typically range from anywhere from 10 to 50, I would say more like 20 to 50% is usually a good one. 10% up front is more for like an earnout, something like that, where you're going to be helping, convert the clients over to fee based, or manage money, whatever it may be. Those are the smaller down payments that you may see in the 10% range. Most of them are going to be in the 20 to 50% range. 50% range usually for internal acquisitions where you're not repapering clients, you're just a rep code change or negative consent letter may be going out, something like that. Two different options in terms of financing. Obviously, seller financing, where the seller, you as the seller is holding a note, anywhere from 3 to 6 year period, charging anywhere nowadays, 5 to 10%. It used to be, I would say 5-6%, obviously a little higher now these days. So you could always hold a note yourself. You could always go to somebody like Dustin with PPC loans. They could do bank financing for you. Really good way to kind of open up the cash flow. I'm sorry, a really good way for you to, not have to hold that note, and worry about being paid on a quarterly, yearly, whatever it may be basis. And another way of getting paid out is to take a certain percentage of revenue from the buyer for 2 to 5 years in an earnout. Those work out really well if you're, open to sitting there and kind of helping convert that book over to a managed money to concept. And I think we do have a question here. So how does a sell and stay actually work? Joe, you want to take that one?
Yeah, and let's say you want to stick around for, I mean, there's a few ways you can do it, but let's say you want to stick around for 5 years or even 10 years, right? You could almost have a double monetization event where you can sell the practice, and get maybe, a percentage up front or a certain amount up front, and then you move over to a firm, sort of create that succession piece and have that all set up, and you could stick around and you could still, participate in the revenue, and then as it's kind of like an earn out, really. So like really what you're doing is you're saying, okay, my business is worth X right now, and then as you stay on, you could actually increase the value of that practice over the course of a 5 year period, while still participating in, a percentage of revenue. And usually advisors will do that when they want to take some of the day-to-day tasks off their plate. They get to the latter part of their career and they really want to, they don't like doing the compliance or they don't like doing certain things and they just want to focus on what they do. So it makes it easier for them, but they could monetize their practice while they do it. So there's a few different ways to do it, but that's a good question. Thank you.
Yeah, and I think that you can, you could really go in the process of selling your book and get paid a salary as you're staying, depending on, what you want to do. If you're working full time, you can get a salary, you can still get the payout on the book, and we've seen that happen as well too.
Yep.
But we'll turn this over to Dustin. I'm going to go over to his slides and market evolution.
Yeah. Thanks, Dustin.
Perfect. Thanks, guys. I think this is a perfect transition, even with the question answered, because, structurally speaking, the sell and stay can be done, arguably with an external sale or an internal sale, depending on, what you ultimately classify as kind of staying around. But when we look at deal structures today, one thing I like to always point out is how much we've seen the market evolve over the last 10 years. And I use that time frame because prior to 2013, there were not any specialty lending programs. we had been the first company to bring a program to market. Unfortunately, that flew under the radar because it was late 07, early 08. And after about a handful of loans that were funded, the financial crisis hit. We took a step back. And then it was 2013 where ourselves and one other lender came to market. And since that time, obviously, capital options have grown. But prior to 2013, there were no lenders serving the market. And really, one of the primary ways of getting the deal done was through seller financing. And for most buyers, they're going to be somewhat limited in how much cash they were able to bring to the table at closing, especially if you're thinking about multi-million-dollar purchase prices. So it was commonplace to see cash at closing be as little as zero, or sometimes as high as 30%. And I'd probably say that 10 to 20% range was most common, just based on available resources, with the seller technically shouldering most of the risk through the sale of their business by serving as the bank and taking typically a seller note, or an earnout, which may be a percentage of revenues. But again, the seller was self-financing the deal over, maybe a 5 to 7 year period in most cases. But, moving forward, starting in 2013, with the availability of capital starting to expand, you would start to see a shift in the cash at closing. And as we were designing the program, that was really a value add we could see that was being brought to the market. The ability for the buyer to provide more cash at closing. It was a shift in risk from seller to buyer, because again, they're borrowing the money, they're at risk of a potential default if something goes wrong. But the seller is now transitioning away from shouldering most of the risk by self-financing a much smaller percentage of the deal. So out of the gate, with new programs coming to market, they're always going to remain somewhat conservative. And, as we funded more and more loans, we saw the ability to start shifting that structure even further as you move into 2016 and 2017, where the cash at closing was actually growing exponentially. And in the early years, let's call it that 2013 to 15, it was expected that there'd be some level of financing. And we typically limit ourselves to somewhere between 60 to 70% of the purchase price for the bank loan and require seller financing for the difference. Now, the seller isn't financing 70 to 100% of the deal, but they might only be financing 30, 40, 50% of the deal during that time, maybe more if they structured the deal and wanted to structure it in a manner that would require more seller financing, but wasn't a necessity now that bank financing entered the picture. So moving forward, 2016 to today, the market's completely changed. There's multiple lenders serving this space. There's capital options beyond just banks. You've got banks, you've got broker dealers, you've got sellers. You may have businesses nowadays that can self-fund, or maybe they're just using outside investors or private capital that they have access to. But because of that, and because of the competition, we've seen cash at closing grow. And I use the 50% to 100% range because in some scenarios, maybe a buyer has negotiated a more favorable price with no downside protection and is giving the seller 100% at closing. Maybe the seller's already joined the buyer. They've transitioned the clients, the relationships have been transitioned to the buyer, and they're just looking to close out the sale. So in those kind of unique cases, you might see a seller get all cash at closing. But in most cases, it's still, probably 50 to 80% in terms of what we're seeing. And depending on, what the risk level is for the transition itself. And seller financing, ranges anywhere from 0 to 50%. One thing we do annually is also really evaluate the data and the markets and how they performed over the past year. And that data is actually consolidated with a few different companies that we come together with to, really get a large sample set. And And moving forward to the next slide, Scott, what we have here is M&A trends in 2022. And I would say it's pretty reflective of what we're seeing today. But when you think about the financing sources, as I mentioned, we've consolidated data, and this is hundreds and hundreds of deals that represent this sample set. And of those deals, 54% roughly were bank financed, 48% were seller financed, and 12% were financed by the broker dealer. So there are a few broker dealers, for some of you that may be aware, they do offer some level of financing to their advisors. But you're also going to see that comparing that option to what most lenders like ourselves are offering, it may be somewhat limited. They may not be willing to finance 100% of a purchase price. They may not want to finance a deal over 10 years. They may require a cash payment, and it may come with some additional restrictions on your flexibility, your freedom to move broker dealers down the road. So the broker dealer financing we've seen become a little more prominent, but it's still somewhat limited across the board. And also the options and the terms we find are typically a little less favorable than what a buyer might find through bank financing. Now, moving to the next statistic, deals with clawback. These are specific to transactions or acquisitions. And what is going to bring this percentage down to 45% is that the numbers that are feeding this do involve internal succession plans. So if you have, a seller looking to sell in tranches, they're likely getting 100% cash at closing for each and every tranche they sell. And there's really not a need for a clawback because the buyers are working internally, they have relationships with the clients, and there's no need to look at potential attrition down the road. But in acquisitions, where a seller is selling 100% of the business, maybe they're staying on 6 to 12 months for transitional purposes. Maybe they're staying on for a few years, even longer, and simply servicing the clients. As Joe mentioned, in some cases, they may want to continue working for a number of years, unloading the ownership responsibilities, and just going back to client-facing activities as they, slowly work out of the business or transition out over a 2 to 5 year period. So deals with clawback specific to acquisitions, I would say that's probably even higher, maybe even almost double that amount when we think of acquisitions that we're ultimately funding. Because for a buyer who has no relationship with the seller, they obviously want to make sure that the seller has, or there's a vested interest in transitioning those clients post-closing. Average seller note terms, this really matches up with what Scott and Joe are seeing in the market. I mentioned the 3 to 6 range. On average, we're seeing 5-year terms, but it's not uncommon for us to finance 100% of the purchase price and disperse funds over a 12-month period, maybe some at closing, as well as some 12 months later based on the clawback provision. And we're actually going to run through a case study, but the reason we're seeing more transactions or more buyers approach us requesting 100% financing for an acquisition is really due to the length of repayment. So a 10-year term versus a 5-year term is obviously much more favorable for cash flow. Rates are going to be higher with bank loans versus what we're seeing through seller notes. But again, it's not so impactful, or at least that interest rate difference is not so impactful that someone is looking to shift a large portion of the debt to a seller note on 5 years. And considering valuations having increased over the last 10 years, everybody's seeing the market multiples, and this will be another slide we touch on next. It makes sense that buyers would want to look to find debt options outside of a seller that do give them the ability to repay over a longer period and reduce the monthly outflows. All cash deals, 55%. Again, another metric that's probably brought down by the internal equity purchases or a buyout where the seller gets all cash. But again, not uncommon to see the sellers get all cash within a 12-month period. especially for those ultimately looking to exit the business and not sell and stay. And last, the down payment by financing type. This is kind of feeds into another one of the metrics that Scott and Joe also referenced early on. When there is not a lender involved, you can see there is a massive difference in how much cash the seller gets in closing, whether it's a seller selling 100% of their business or doing an internal sale in tranches where maybe they're selling 30% every other year, or a third of the business every other year for the next 5 years roughly, or maybe they're trying to transition out over time. They will get larger cash amounts at closing, and so will those looking to exit the business with 12 months when they use an external lender. And it's really the availability of that capital. Someone not using external lending, someone trying to structure a deal with more contingencies, they may have limited resources in terms of what they can provide to a seller at closing. So that's why you see such a large variation in down payment by financing type. Again, with the capital available to the market from lenders, it's definitely pushed up how much cash they're getting over time. Let's see, I was just looking to see if any of these questions were specific to these slides. So let's move on. One thing I wanted to address or go over as a case study is something we're seeing somewhat often. And when I was referencing how the market's evolved, we're looking at all cash deals, we're talking about clawbacks. For a lot of business owners or a lot of sellers that are solo practitioners or don't have a team internally that they're going to transition the business to over time, it's not uncommon for buyers to approach us requesting 100% of the purchase price. And I wanted to talk through how that works, because for a seller looking to really just support the transition period and exit the business in 6 to 12 months, this can be very favorable. It doesn't involve seller financing, and it really simplifies the exit process for both buyer and seller. So if we're looking at a $2 million purchase price, and let's assume a January 1st, 2024 closing, a buyer would approach us, put in a financing request for $2 million. If approved, the deal structure would typically involve somewhere between 50 and 80% of that $2 million price to be funded at closing, with the remainder funded in 12 months based on client retention. If there's any excess level of attrition below maybe some sort of 5 or 10% attrition allowance, then the price would be adjusted. But if not, that second amount is released in 12 months. And this is very favorable for a buyer for a few different reasons. One, they come to get financing, they are approved for both payments today. There is no new underwriting, there is no new approval 12 months down the road. What we simply require is confirmation, written confirmation from buyer and seller that they're in agreement that the holdback or the amount of the holdback should be paid, or 100% should be paid to the seller, or if there's an adjustment of price, they both highlight that a lesser amount should be paid. Again, this results in the seller getting 100% of their cash within a 12-month period. They do not have to seller finance the deal. They do not have to deal with an earnout over 3 to 4 years. And again, typically they're just providing transition assistance to make sure all the clients move over and the relationships with the buyer established. The benefit to the buyer by using a holdback versus escrow is really highlighted in the next slide. And when you're looking at the disbursements, if we're only dispersing $1.5 million at closing, the buyer is only paying principal and interest on that amount. And once the remaining amounts dispersed 12 months later, the payment ratchets up. So I highlight two options here because it is common in some instances for escrow to be used and to hold those funds for the 12-month period. We don't require an earnout, or a escrow account. We will simply leave the proceeds undispersed And this can be beneficial for the buyer because you can see there's a much lower payment during the first 12 months. This frees up cash flow during a transition period when maybe revenues are taking some time to show up. And it can also be favorable for a buyer who's looking to reinvest back in the business, and seeing some early free cash flow can be helpful. So the 100% financing case study becoming a little more common. And I like to put it out there when we're talking to sellers, or primarily sellers, because again, this can be a good option to get cashed out within 12 months and exit the business if that's ultimately the plan.
And yeah, thank you for that, Dustin.
Thanks, Dustin. Yeah, that was
And
great.
there was I have a question, a couple of questions here. First one is, can you address how you might handle the sale of a transaction with an independent boutique commission-based financial planning practice? And I think that a lot needs to be looked at of where the revenue is actually coming from on something like that. Commission-based practices can range anywhere from 0 to 1 times multiples for the most part. So it really needs to be delved deep into what the assets are and what kind of products they are. And, if there's high surrender charges or whatever it may be, you may not get anything. Or there may be some level of goodwill if there's a mix of a book of, some fee based and some commission based. You may see somebody paying a quarter basis point on something that typically wouldn't be paid out on. That kind of goes into the next question from Sherry. How is the purchase price calculated? The multiples that we're seeing now, we'll hop into that a little bit as well in the valuation slide. Multiples, kind of ties right into this. Multiples that we're seeing, on the managed money portion, we're seeing anywhere between 3 and 3.25 time right now of multiples of your revenue. Trails, we're still seeing about 2 times, and then again, commission-based revenue can range anywhere from 0 to 1 times. Dustin, is that kind of what you're seeing as well too?
Yeah, and I think that matches up really well with the data. Again, everything we consolidated, if you look at the next slide, this really highlights what we're seeing with regards to recurring revenue multiples and transactional revenues. You kind of broke the recurring down into managed money and trails, which I think is a good way to look at it. And when you're looking at the next slide, the M&A trends and the revenue multiples we're seeing, that has grown over time, and our data actually consolidates recurring revenues, or consolidates the managed money and trails into one recurring revenue multiple. And it's averaged, last year it was 2.83 times. It was down slightly to about 2.8 times, or I'm sorry, in 2021. And then in 22, it was down to about 2.8. But I'd say 80% of the transactions, the recurring revenue multiple, and that'd be on the gross revenue, is probably between 2.5 and 3. And again, that lines up with what you're seeing, with a slightly higher multiple on managed money and a slightly lower multiple on trails. And most importantly, the quality of the book's going to have an impact on that. Is someone buying a business where 80% of the clients are age 70% or older? The average recurring revenue multiple on something like that is probably going to be on the lower end of the range, and see some discounts. Whereas, high quality growth oriented firms, not uncommon to see even 3 to 3.25 paid sometimes. Not the largest percentage, but high quality books can draw that 3 times multiple. And with the competition out there between buyers and limited supply of sellers, it's not surprising to see that stay the same. And when you're thinking about the valuations, we've really not seen any material change in the valuation of these businesses when you consider interest rate increases, the macroeconomic factors, shifts in the market, maybe uncertainty around where the stock market's headed. For all those variables, you'd think, hey, this is a time where we're likely to see some sort of impact on revenue multiples, and we're really not. Across the board, I'd say things are pretty flat. You might hear, in the headlines when you're thinking about large aggregators that, the shift from in risk from seller to buyer has moved a little bit more back to the seller. You might hear that, people are more selective. Deal structures kind of reflect the changing environment, but not necessarily revenue multiples. And while I agree with that, on a smaller scale, for the firms that are smaller in size, sub 300 million in assets, and specifically to those kind of solo practitioners, it's really business as usual. I mean, we're not seeing a lot of change in how deals are being structured compared to what we were seeing over the last 5 years. So I think that's important to point out here. There was one question here I'll address real quick from Randy regarding attrition, specific to a clawback on some of the slides I was discussing. The 5 to 10% is the allowance that is typically provided to a buyer. So if 90% or more of the client revenues are retained 12 months post-closing, there is no adjustment to price. So if the clawback provision allowed for a 10% attrition allowance and 85% of the it's called client revenue was retained, there'd be a 5% adjustment to the price.
And we've seen it go to 85 as well, Randy. I think 90% is typical these days, but I would say 85% is probably doable if you're working with the right buyer. I wouldn't expect it, but it is doable.
And I can tell you, we've been doing this for over 10 years now, lending to the advisory space. I can only think of one scenario where a buyer or the retention fell below those levels.
Yeah.
Maybe it touched in the 85 to 90% range, but that was strictly due to a seller setting up and pursuing and soliciting clients that they just sold. So it was a one-off scenario that's now a legal battle. But what we're seeing in almost every case when buyer and seller work together, retention rates are strong. They're above 90% in most cases.
Yeah, we see that too, Dustin. I think it's very rare where we see less than 5% attrition. Honestly, yeah, I think that goes back to finding the right person, having the right fit, and as long as the seller is willing to stick around and help transition, which in many cases they are. I don't think we've also been doing this over 10 years, and I don't know that I've seen anything less than 10% ever, honestly, in any of our transitions that we've done. So yeah, it's certainly a good thing, but it's there for a reason. The retention number kind of keeps the seller honest in a sense.
I think most of the time you'll kind of know too. I mean, if you have, I've seen, we actually are working with a book right now where the advisor has 75 million and 50 million of it is with one client. So you may want to do something a little different on something like that, and that may be a contingent number. So if you have a really big client and you are unsure if they're going to move over, I would certainly look into some different options as to how you may want to do a deal like that. It may have to be separate or contingent upon moving over or something like that. But that may be something that may play with that number a little more than normal.
Agreed.
Michelle asked a question too, Dustin, if you can get to that one about the payouts.
Sure. Potentially, so there's a few things here. Our holdbacks that we use are typically capped at 12 months. I might be able to move to 18 months, but the reason for that is the money is considered lent and therefore off the bank's balance sheet, but it's not earning interest during this holdback period. Now, you could use escrow, and it's not that favorable for a buyer because there could be hundreds of thousands of dollars sitting in an escrow account for a few years. And if it's not needed till year 2 or 3, wouldn't make a lot of sense to borrow it today. So we do see some scenarios where a deal might be structured with, let's call it 4 lump sum payments. one at closing and then one 12, 24, and 36 months down the road. For those deals, we will typically fund payment 1 and 2 for the buyer. We'll basically pre-qualify them for the entire deal, but then come in 2 years down the road and do a new loan for payments 3 and 4. So there's ways to do that. The banks have the ability to get creative. From if it was monthly or something a little bit more consistent in terms of the monthly payout, you might want to find some other options there. But generally, if they're lump sums over the course of several years, that would be the best way to do it, so that a buyer doesn't have too much money sitting in escrow over a 3 or 4 year period.
Okay, great. And I just wanted to pop back on the business valuation slide here. If Joe's going to get into this a little more.
Yeah, I think this is just pretty just preliminary things you want to have together. I think having a valuation done on your business. To go back on what Scott was saying, and Dustin also, is that's going to be just like a fair value for your practice. And some of the things that you might want to have together, I mean, it's important. We provide, and we're going to send everybody who's on this webinar today a practice profile, which is really just a high level 2-pager that goes over a lot of the information that you would need for your valuation. And we're happy to provide you with a range, and we don't charge anything for it. But basically having all your necessary information, P&L reports, revenue breakdowns, tax returns, those are all things are good to have when you start thinking about this, because that's going to be part of the due diligence as well. And certainly helps put together a valuation, and then obviously determining what a fair price is. We talked about multiples and what we're seeing now, so we went over that. Tax implications. None of us are CPAs, but I know you want to structure it more as capital gains versus ordinary income. So there's different ways to do that and structure it so that the majority of it is taxed on capital gains. Now, obviously, if you're a W-2 or you work with one of the wirehouses, typically the sales on that is structured as ordinary income, which I think is a benefit of being on the independence side. But and then obviously talking to your CPAs we always recommend that. Even we help put together all the purchase agreements and everything, but I always recommend having your own attorney look at it, make sure everything looks good, as well as talking to your CPA about how to structure it from a tax standpoint.
A couple of questions here. With regards to retention, how would an increase be addressed? I mean, if you're seeing new assets come on as you're transitioning over, something you might want to have in place would be like a solicitor's agreement or something in place where any new business comes over, you guys split commissions or whatever it may be. But you can come up with some sort of a situation where you guys are, basically splitting or whatever it may be that feels comfortable for you on any new assets that come in. And then can capital gains be an option for a sole proprietorship? Yeah. I mean, I think that if you have your own entity set up, your own S Corp or LLC or whatever it may be, capital gains can absolutely be an option and for a sole proprietorship. And again, definitely reach out to your CPAs because we're in New York. I'm not sure, Randy, where you are, but I would definitely ask your CPA this stuff because again, we are not CPAs, and I don't want to lead anybody into a path that might not be advantageous for yourself. So.
Yep, and also just to go back on that first question that Scott addressed about the increase. So I've also seen, and this is something you can do too, is you can base it off of the S&P, like the index at time of purchase, and say like if the S&P increases by 10% or decreases by 10%, you could have things that offset that as well too. So there's a lot of different ways you could kind of handle that part of it as well. But yeah, and then just kind of going into items that affect the valuation. Scott, you want to hit that, or you want?
Yeah, recurring revenue is obviously king. recurring revenue is getting the highest multiples that we've seen to date so far.
Specifically advisory.
Specifically advisory managed money. I mean, three
Yep,
to three and a
agreed.
quarter times. So obviously that is a huge impact on what your valuation is right now versus transactional revenue, which is again transactional revenue anywhere from 0 to 1 times. It just really depends on what the product is, and if there are large surrender fees or whatever it may be. Client demographics also can play into that to valuation big time. Age demographics of clients. If you have a good book that most of the clients are under the age of 70, you'll see tick ups in multiples that way. If you see books that are starting to age and you're starting to see north of 80, you're going to probably see that multiple come down a little bit. Number of households also another key part. If you have 100 million with 100 clients, your book is going to be worth more than if you have a book of 100 million with 1,000 clients. So better, higher client value, more funds, less clients, less work being put into it, always going to be higher multiples for you. And how transferable is your client base and their assets to a new firm? Clearly the portability of how your book plays out and where you're able to sell it off to is also going to play into your valuation. Got a message here. Assuming trails are paid on annuities, are surrender fees good because the asset is sticky or bad because it can't be moved? Um,
I mean, it's that's a good question. Thank you, Sherry. Yeah, I mean, I think obviously the trails on the annuities. I mean, that's going to be it's recurring, so still a good valuation there. Most people want to take the trails over the upfront on the annuities because yeah, I mean the asset is if they're in surrender, if a majority of the annuities are in surrender, then it's a little bit easier for the buyer to take those, that you can convert that money into fee based, or there's different options that you could do with that. But yeah, I think
I don't know if I would say indifferent. I don't know if it's good, bad, or I would say indifferent, honestly, because you're getting trails on it. So you're going to get, most likely 2 times multiples on it, but they're stuck in surrender or the surrender fees. So they'll be stuck in there. And it really depends on how you look at it. I don't think that's good or bad, to be honest with you. I think if you have an advisor that wants to try to convert this stuff over, that they may see it negatively, but I don't think so because it's guaranteed trails. So
yeah, I mean the tricky part of the annuities are when they're like fixed index annuities. If they're all just recently written and none of them are coming out of surrender, that those aren't producing trails most of the time, so there might not be any value to something like that. So fixed index annuities are the one that those are usually a little bit more tricky to value.
Yeah, I'd agree with that too. Just from what we see, working with buyers, it's kind of buyer specific. Some buyers may come in and say, "Look, we're here for the fee based revenues, and we're not going to give you much value for annuity trails or commission based." But yeah, I think for the most part, I'd agree. It's kind of somewhat indifferent. Just depending on the situation and how much is ultimately applied to annuities. Maybe insignificant, and someone says, "Yeah, I'll just kind of roll it in with the rest of the recurring revenue."
Yeah, no, absolutely. And again, that's going to depend on the buyer too, right? I mean, if a buyer does annuities and is part of their book, that they might value that higher than somebody who has no interest or doesn't do any annuities. So yeah, that's certainly going to affect that. We have Randy had asked another question here. Client household is high due to quite a few simple IRAs. Participants are adding to their account monthly. Will this help or hurt your valuation? Again, I mean, I think it really just depends on what revenue is being generated and how that's coming, how that revenue is being derived from. I think I don't know that this would necessarily help or hurt it. It depends if you have all simple IRAs and they're contributing to it on a monthly basis.
I don't think it's going to hurt.
No, I don't think that would hurt the valuation. And again, it's just a matter of what revenue is being produced from those assets.
Yeah, typically you're going to look at a 12-month, 12-month stretch, your last 12 months. of revenue, and that's kind of what your valuation is going to be based upon. Yeah, unless you're, we usually ask for 5 years revenue to take a look at what's going on, because you may have some people that are trying to window dress their practice a little bit. And if you start to see big ups and downs in the revenue over 5 years, you may take an average. But for the most part, you're looking at a 12-month, trailing 12-month number as to what you're actually going to look to apply multiples to. So I don't know if I don't think it will hurt, but I'm not sure that it will help either. I think it's kind of indifferent, to be honest with you.
Yep.
Yeah, regarding I know we just kind of walked through all the items that affect valuations, and Scott, feel free to just kind of get towards the end of the slide so all the information's in
Yeah.
front of everyone. But we get a lot of questions as a lender about valuations and how they've been impacted with interest rates. The items that affect valuations that we just went over, Scott, Joe went over, are obviously the most important things that are going to really drive the value of your business, either higher or lower. But sometimes, with regards to interest rates, it's going to potentially impact the buyer and what they're willing to pay due to cash flow. And I like to just throw this out there because when we're thinking about the history of the M&A market, and again, lenders coming into the equation in 2013, it's been pretty flat in terms of the rates that we've been able to offer the market over those time period. I mean, they've fluctuated up and down at different times, but obviously it's been a very long time since we've seen this level of interest rate increases. And if you noticed in our recurring revenue multiples, there was a slight down. It's down slightly last year and probably flat this year. So while the interest rate increases haven't seemed to impact valuations, or at least, they haven't necessarily impact valuations, they may have an impact on what a buyer is looking to pay. And I think more than anything, this interest rate increase has pushed some buyers to the sidelines. And what I mean by that is we haven't seen deal activity slow. It seems to be pretty consistent with the amount of activity we've seen over the last several years. But we have seen just an overall interest from buyers somewhat decline. And what I mean by that is you likely see first-time buyers, people who haven't done an acquisition in the past. Maybe we're starting to consider it as we get outside or further away from the pandemic, and they're starting to feel more confident in their ability to buy something. They feel stability in the market. But when they start evaluating current interest rates, I think it's pushed some, again, first-time buyers to the sidelines. But we are seeing it hasn't impacted experienced buyers at all. They're looking for good businesses. They know that even at, let's say, a 3 times multiple for a good business, there's an opportunity to ultimately get a return on that investment over time. And they are willing to move forward with the debt option despite the rising interest rate environment. And I would tell you that, from an interest rate standpoint, 10.5 isn't necessarily what's in the market. I mean, there's definitely, we're offering rates in the 8 to 9 range right now. But we've had to refinance quite a few loans this year that would be at 10.5. So, buyers who had leveraged SBA loans over the last 5 years likely were in the prime +1 to prime +2 range. And, that's what's reflected here is prime +2. And you can see how the impact on the monthly payment or the annual outflows can really kind of start to have a material impact on the bottom line, or at least the EBITDA the buyer's purchasing. So, not seeing a huge impact on interest rate increases as it relates to valuations, but, may have changed a little bit of the mindset or forced buyers to want to, shift some of the price to the seller at a lower interest rate, or, potentially offer something slightly lower to make up for that change. But big picture, I think it's, there's still a lot of activity. There's still a lot of interested buyers, and it can still be a great time to sell your business.
Okay, thanks, Dustin. Yep. So I know we're kind of approaching the end here, so I want to run through this real quick. Just kind of talk a little bit about the timeline and implementation. You want to have a clear timeline. I mean, it's not necessarily always going to be black and white, but whether you're looking to get out in a year, 2 years, 5 years, or more. Will determine ultimately how you want to structure, who you're going to want to work with, and that's important to know though. And then obviously if you're looking to grow and structure an earnout, or if you want to really just kind of sit back and you're not looking to actively go out and bring on new assets. Another thing that's going to kind of factor into how you structure a potential deal. And then maybe all you need is a contingency plan for now. Maybe you don't want to structure some sort of merger or sale. Maybe it's just, in the event you get hit by the bus, right? I mean, everybody's always talking about getting hit by the bus. You want to make sure, I think, 90% of advisors do not have any sort of succession plan in place, which I think is eye-opening to think about, really. But I think there's a lot of mandates going around internally with the broker dealer, the DOL, talking about succession planning. So I think even just a contingency plan is important, and then really just a well structured implementation process. How you want that to look, and again, just finding, like we've talked about, you just want to find the right fit so that it all works out and the retention numbers are high and things like that. So these are just certain things to kind of think about as think when you start getting to the end there.
And then finally, kind of who we are. We're a consulting firm. We specialize in really matchmaking. We have a bunch of buyers that we've pre-vetted, that have done this before, that we feel very comfortable with, in most regions around the country. And we kind of make the matchmaking process a little easier for you guys, as opposed to having to go on to like a listing service and stuff or something like that, and having to be inundated with maybe 100 requests on your practice within the first 24 to 48 hours. We do it one at a time, and again, we've pre-vetted buyers, people that have done this before, people that have capacity to bring on additional assets and clients. And we, help facilitate that, through the whole process. We do legal documentation is done in house with us. Valuations is done in house, and then again, Dustin is kind of our preferred financer for these things as well too. So if you don't want to hold a note, you can certainly make that a requirement of the buyer, that they go and get buyer financing through a bank like Dustin's, and there's absolutely nothing wrong with wanting that at this point. So if you think that we can help you out in any capacity, feel free to reach out to you. We'll be reaching out to you guys in the next week or so. We'll be sending out a copy of our practice profile, like Joe had said, and we'll be reaching out to you to see if we could be of any assistance to you in any way, shape, or form. So do appreciate everybody's time here. Here's all of mine and Joe's contact information. I will include in the email as well, Dustin's as well, Dustin Mangone's contact information. So if you need any help from him, feel free to reach out to him as well. And we do appreciate everybody's time today.
Thank you, guys. And thanks, Dustin.
Thanks, everyone.
Yeah, we really appreciate you joining us today. Thanks, Dustin.
Yep. Thanks for having me. Thanks, everyone, for joining us.
All right. Have a great day, everyone. Thank you.